Yes, good morning, everyone. My name is Greg Coleman, and I'm on the agenda here as representing Independent Resources. That's one of the things I do during the day. I do the Petromol thing at night. Independent Resources is a very small company. It was originally created in 2005 to be a gas storage development company in Italy. And I joined the company about a year ago, having worked at the company working on this gas storage project for 10 years. I discovered still didn't have a development plan, didn't have a financial model to describe how much it might be worth to anyone, and didn't have any alignment of the stakeholders, particularly in Italy. And so the whole project has been scrapped, frankly, and 10 years wasted and several million, fortunately not several billion pounds of or euros of money have been not written off, but tens of millions have certainly been written off. So what I wanted to talk about, being an engineer is a bit strange. I'm planning to sort of think about this as from an investor perspective. Since I retired from BP 8 years ago now, I've spent the last 8 years raising money effectively for startup companies, now for a company that's been in existence for some time. And frankly, we have such a poor record as an industry that our investors are not very interested in investing in us anymore. In BP, I spent a few years trying to explain to our investors why we couldn't grow as fast as an IT company in California or a manufacturing company. Investors have expectations, and frankly, we can't meet them. And I think we've been fooling them for a long time that we pretend we can meet them. And so we make going back to David's question about, the CEO all of a sudden says we need to accelerate the project by a year to meet the financial threshold that he has in mind or that his investors have in mind, is in itself an example of how we do things. The CEO should have known that the project was going to deliver a low return long before it came to the final decision about whether or not he should release the $5 billion or 50 million pounds or whatever it is. The size of the company, of course, means it's more difficult for a CEO who's looking at maybe 50 projects to know what's going on in each and every one of them. But the fact that it would get to that stage where that big disconnect exists in itself, I think, is an example of how we do things, and it needs to change. Investors also are much more able to change their minds. They can sell your shares if you're a public company very quickly, or they can just walk away from the investment if it's a private company and there is no more. And I think that in itself is something that needs to be managed more carefully. So having investors who are prepared to stick with a project for the length of time it takes to go from deciding to explore to getting some positive cash flow is very important. In our industry, I claim that's between 10 and 15 years. And most investors don't have the patience for 10 to 15 years. Most of them nowadays, especially in the public markets, it's month to month, or if you're lucky, quarter to quarter. So if you announce a project and then a year later you decide that it's going to take a year or two longer because you didn't tell them the whole story, then I think we have a significant gap between promises and delivery. And a 10 to 15 year project requires someone, I would assert, a group of people to be with that project for 10 to 15 years. The same person or people, hopefully, for that length of time. And how many people here have worked on one project for 10 years? Most of us, including me, we get bored after about a year and say, we're looking for something else. We're ambitious, or, you're encouraged to get promoted, or you want to get more money, or family circumstances, so you move, and you move quickly. And if you talk to my family, we moved 18 times in 20 years. I can guarantee you that they weren't all working on the same project in 18 different locations. They were just 18 different projects over those years. And that, I think, is an example of what goes on for most of us. Maybe not quite that frequently, but that's the sort of challenge we have. So how do you encourage people to stay in a project for 10 years or longer, to see it from the beginning to the end? Another question, just more local, is this an issue, this lack of project delivery in the North Sea, or is it a global problem? And I think we've heard from Graham and from David. This is across all projects, whether it's IT projects in California or E&P projects. But it's particularly an issue in the North Sea because we've gone from having a lot of large companies, Shell and a BP, who could afford to learn through a few difficult projects, now to smaller companies. And a very good example, which I follow very carefully, closely, because of some interests I have had in the past, is a company called Excite. I don't know how many of you follow Excite. They're developing a heavy oil field called Bentley in a heavy oil area in the North Sea. And I think they're doing an exemplary job of the shaping process. However, it's taken 6 years. They've sold a bit of oil. Their share price has gone from a high, I was just checking, it's gone from a high of 387p to today it's about 30p. So somebody has made a very poor investment if they got in at the top. If they invested early on, they're probably at about 50% loss on their shares. But the project will probably be a technical success. But some shareholders will do extremely well and some will do very poorly. The management have been there for these 6, 7 years. They probably spent 10 years before that figuring out how they could get their hands on it. And they're probably going to have to be there for another 10 or 15 years till it's delivered. That's commitment, but it's also all or nothing for them and for that project. And if they don't do it well, then they probably won't benefit, at least financially. And there are other examples in the North Sea of small companies who've taken on projects which, frankly, they don't have the financial or people capability to deliver unless things all go well. And shaping for 5 years or 10 years and developing and getting the front end loading and all these other engineering type things done right is not well rewarded by the investors. And then the last thing, just to bring it all home, we're all living through this apparent surprising drop in the price of our product, oil or natural gas. If you were in the States a few years ago and the price of natural gas dropped from $20 an MCF to $2.50 or something like that, or today price of oil going from 100 and something to 70, maybe 60, maybe 50. This is not a big surprise. It shouldn't be anyways, but for a 10 or 20 year project, you need to be expecting to have 3 or 4 of these cycles, if you want to call them that, or at least volatility in our product. And there's one company who says that they've been using a long-term price of $80 Brent. I suspect today they're probably wondering if that's the right price. At least they should be explaining it to their investors about why that price makes sense. But no one actually knows what the price of oil is going to be in the next 5 to 10 years on any particular year or any particular day for sure. They may have long-term expectations, but they must know something about supply and demand that no one else has been able to figure out. So on a 10 to 20 year project, you need to expect at least 3, if not 3 or 4 project price moves from 100 to 50 or 20 to 10. And so it does mean that you have to be very clear about what your cost structure is and what you can afford. And quite often, many companies have been designing projects on the basis the price is going to be $100. Makes it project look good anyways, at least on a rate of return basis, but it's doomed for failure. And so, to kind of bring this all together, no slides or anything, is just to say the concept Graham raised of risk, describing the range of potential outcomes early on and making sure that people, investors in particular, understand that is a recipe for not being a CEO for very long, because your investors won't give you any money. If you mislead them, you won't have a job for very long. So I say, there's a lot of work I suspect most of us in here are in this industry in some way or other, spend a lot more time educating our investors about what they should expect. And they shouldn't expect a 30% rate of return, which is what they want. And if they're an explorer, they probably want a 50% rate of return. They should expect something better than whatever the cost of capital is. It must be 15% nowadays or something like that. They should have a right to expect that. Most of our projects could deliver a 15% rate of return if you have a portfolio. If you have only one project, if it's Excite in the Bentley field, they need to deliver some 30 or 40% rate of return because their investors probably have a group of companies like them and they don't mind writing off Excite and they don't mind writing off 2 or 3 projects. They need to have 4 or 5 out of their portfolio that work, and then they'll get their 15% rate of return. But we don't educate our investors very well. In BP we didn't, in my former company we didn't, and in my current company we don't. Mostly they don't want to know. It's easier for them to move on. Mostly we're not so interested in engaging them. We like the short-term glory of the price spike, and then we'll worry about what comes next, tomorrow. This is all a very big detriment to projects, I have to say. And to summarize, if we don't do a better job, there will be no new money for the industry. There may be some money. There are always some gamblers. But it does make it very difficult to see how we can move forward. On a more optimistic note, we do need oil and gas. I don't really buy into the notion that we'll never need oil and gas, at least not for the next 50 or 100 years. So eventually the money will come back. Price of oil is $30, probably do quite well if you invest at that level. If you're investing when the price is $150 and the projects are all looking fantastic, you're bound to be disappointed. So I think it's about thinking over the 10 to 15 year horizon, planning on that way, describing the range of uncertainties that might occur over a 10 to 15 year period for any particular project, and then making sure that you're prepared to stay the course. So that would be my message. I don't endorse all of what Graham said, but he and I lived through several projects where we were told by the CEO that we needed to go faster and needed to do better. And sometimes you do what you're told. Most often Scott never did what he was told. He always did what he thought he should do. That's why he's looking for a job, I suppose. Happy to take any questions, but thank you.
Thank you. I'll tell you what we'll do. We do have a long Q&A session at the end, so we'll take questions then half an hour before lunch. Where's Marcus? Marcus, you're up next. Also, no slides. Indeed. Also, no need to believe what I said earlier, that you could talk for 20 minutes. Right. 10 and a bit.
10 and a bit.
So, Marcus, how about you?
Just so we're clear, I used to be the Group Chief Executive of Dana. I did not fire Graham, just to put the record straight. I'm also going to give a perspective, I think, from working in the industry and being involved, particularly with a super major for 27 years, and particularly major projects, and then with a mid-cap. And there are some big differences that I want to bring out. But the fundamentals here are about capability, in my mind, and risk. And I thought I'd give you some numbers. So the IEA, which is the International Energy Authority, estimates that $22.4 trillion will be spent on projects in the oil and gas sector between 2014 and 2035. Now, if you're an investor, the obvious question is, where am I going to get my dividend in terms of the projects that I'm delivering? The opportunity cost of investing in the right kind of projects. And one of the interesting things now that I work particularly with the investment side of the business is seeing that different perspective on rates of return. Many of you will realize that today the average return on capital employed of most oil and gas companies is between 12 and 18% on a good day. So there is a big issue here around how money gets spent and how it's then returned to the shareholder. David, in his introduction on the web, talked about 3 issues: under appraisal of reservoirs, inadequate project design and concept selection, and a lack of quality assurance of project execution. Now, as a person who went from geology into reservoir engineering, into commercial, and then into senior executive positions, the first thing I would say is it's amazing how quickly we reduce the problem down to a single set of numbers and don't recognize risk. And that actually translates through the whole process. And my surprise in going into reservoir engineering, which is the bridging point into commercial, is actually that things get turned into numbers. They get in terms of reserves and rate profiles. And the reality is the balance sheet is dominated by reserves, which is an easy thing to define relatively simply, but rates of return are determined by risk, all the risks that Graham talked about. The other interesting thing is in the last year, there have been 4 major sort of studies by most of the advisory firms who obviously would love to help companies resolve these problems. First one was by PricewaterhouseCoopers in October 2013. They looked at a whole sample of large-scale projects. E&Y looked at mega projects. They took actually 350 oil and gas projects and looked at them. Accenture, which has a focus very much on systems analysis to support projects, interviews 61 C-suite level set of executives. Now, every one of these studies says the same thing, which is kind of interesting. So the obvious question is, why aren't we learning? And here's some basic data. So imagine the $22.4 trillion of spend. 50% of projects don't meet their objectives. 64% of projects are facing cost overruns. 73% of projects are reporting schedule delays. And in one of the studies, 205 projects that actually had cost data and schedule data, 59% were above their original estimates, which reflects an increase in the costs of those projects of $500 billion. Now, you wonder why the investment community is concerned about what's going on. And what also they saw is that post the final investment decision, 23% of those projects analysed actually exceeded their cost by a considerable amount. So, what were the root causes? And you won't be surprised by this. The question, though, is why aren't we learning about it? So the first one was portfolio and project management. So misalignment of the investment rationale. This is all around strategic fit. This is around building companies, etc. Access to funding. There's an expectation of certain rates of return. And as particularly the debt market, which is often used for funding projects, goes up, coupon rates goes up, and they start to come to the point where actually project rates of return equal coupon rates, which is not a great place to be. And then there's the whole issue of portfolio management, which both Greg and Graham alluded to, which is small companies may have a few projects and therefore there is no portfolio. It's all about do you or do you not go, and we'll get on to that in a minute. The second thing was project development, this whole issue about inadequate planning. And I would actually contest one of the things that Graham said, that people use major projects, common processes across the world. I have been in many mid-caps and in some big super majors who don't use these processes, which is a real surprise given that part of the problem here is right at the beginning, the front-end loading piece. The other thing is a balance of in-house versus external skills, which we'll talk about in a minute. And then this optimism bias of wanting to move a project forward. The number of times I've sat with a project team who are so determined to move the project forward, it's about doing the project. It's not about running a business or making money. It's about doing the project because it's the right thing to do. And they have a huge support from the contracting community who obviously want this desire to move something forward for obvious reasons. They want to grow themselves. And then finally, project delivery, which is ineffective project management, which we're going to get on to because there's a big difference between project management and major projects management. They are two very different things. They also talked about, one of the pieces of feedback from this study, which I thought was particularly interesting, was 47% of those who responded said that regulatory requirements were one of the reasons why projects didn't come in on time and had to budget. But when you dig deeper and ask the question, why is that? It's because the designs that were put in place were not of sufficient detail to actually create things like safety cases or their equivalents around the world. In other words, the engineering wasn't done. And what were the early signals? Well, the early signals, the first thing is numerous changes in schedule. Christopher Wheaton, who actually gave a great talk at one of the other Finding Petroleum sessions on performance, made a very interesting comment. He said, and this is a guy who runs the energy sector for Alliance Global Investors, and he said, variation orders are not a victimless crime. And the problem is, the moment you change something, after you've agreed to the concept selection, you move into detail engineering design. That's when the price goes up, that's when the schedule goes out. The other thing they found was inconsistent reporting. So what's really driving performance? So as an observation of working in super majors and also in smaller companies, I think the first thing you have to do is recognise skills as one issue, skills and capability, and the other one is risk. And the third dimension is complexity. Now, the reason I raise it is that most of the super majors, and there are some very good ones, and I give examples. Shell delivered their Shell Pearl project, which is the biggest LNG project in the world, on time to delivery, and that was $18 to $19 billion. ExxonMobil Sakhalin, that was a $20 billion project. Graham talked about ACG and BP. It was delivered on time to budget, but for the reason that the facilities exit and export was the thing that was holding things up. So these are very big, highly complex projects, often pushing the frontiers, and they are different in a number of ways. So on capability, it's the super majors and some of the super independents who get involved. In-house capability is in-house, and they have project teams, and they do learn. Now, you might argue about how well they learn, but at the end of the day, there are common ways of doing things. They also have very strong governance processes. These are gated processes that stop things from going one place to another. Graham asked the question, have you ever shut down a project? I shut down a project with in a previous job, and we had spent $120 million. And I have to say, it was a very painful experience. Not from shutting it down, but from the conversations that I had to have afterwards, because the project did not make sense. So you can do that in a super major, as Graham said, and as Greg said. It's very difficult to do it in a mid-cap. The second thing was the fact that the costs of engineering design in those big projects are significant, and therefore you've got to follow a structured process in terms of commitment. And then the other piece, I think, is project management and the supply chain. If you look at the really big complex projects in the world, ones that are pushing the envelope, where the risks are really significant, then the notion of projects guidance versus production guidance is quite important, because you cannot, by definition, describe the risks in detail. And for those who are not geologists in the room, the sample that you take of a reservoir is probably 14, 15 holes in a reservoir, which represents 1 times 10 to the minus 15 of the physical reservoir. So you don't know an awful lot about it. It's a bit like, you know, if you overlay Fortesfield on top of London, and you drill a well, one will hit Heathrow Airport, another one will go in the Thames, another will go in Knightsbridge, another one will go into possibly the corner of Essex. Now join the dots. So when you translate in these very complex projects with all the geopolitics that go with them, there is an issue around representing that risk. The second thing is that these companies use major engineering shops. So the Bechtels of this world, the KBRs of this world, the Wood Groups of this world have done this many, many times on much, much simpler projects, and they themselves are pushing the envelope. And what's interesting is the contract structures that are in place are global contracts for a portfolio, so there's real skin in the game. This is not the case, in my mind, for smaller, more conventional projects, things that the mid-caps would tend to do. So mid-caps tend to obviously come into basins, many of them are mature, and it's often smaller companies where the focus from an investment perspective is keep the fixed costs down and variabilize everything else. And what tends to happen, and there are some very good examples of when things work well, is that you go out to a contracting community which is not the big players. It's actually companies that want to grow into detailed engineering design, but their real core expertise is in front-end loading and concept selection. In other words, screening projects. And then they get dragged into the bigger world of detailed engineering design. And there is an issue because there's neither the capability internally or the capability necessarily in some of these companies to deliver. And so what you'll often see is one-off contracts. Contracts are basically based upon man-hour rates and what's the incentivization. So this misalignment keeps coming up. And this is not me just saying it, it's an observation. I would also say it comes out in all 4 of the advisory company reports. And then in terms of building capability, there is a design not to retain in-house capability going forward. So you add those things together, and the result is that the chances of delivering something on time to budget are clearly going to be a lot less. So what's the challenge going forward? So everybody knows that the oil price, I think today was $66. We are now in the 7th big cycle of oil price volatility. And there's a recent piece of work by Simons and Company that suggests that 1.2 million barrels of oil per day of new production has now been shut down in terms of future projects. The natural response of the oil and gas industry, and I think this is the issue, is that every time this happens, there is a natural tendency to cut costs. I fully understand that. I've done it. I've been involved in it. But there's also a destruction of capability. And if you look at the story of the oil and gas industry from 1970 onwards, basically what we've done is progressively outsource things into the oil and gas service sector. And as the next wave comes through, we then ask the service sector to cut costs. And what's been happening is that the capability has progressively diluted. And yet what we're doing at the other end of the spectrum is trying to push more and more complex projects in the Arctic, in deep water, even some of the unconventional technologies. We're trying to ask for capability, and each time we go through one of these cycles, we are reducing it. And so the question then is, I think for companies, is every time we go through this, we reduce capability and skills. We break down the supply chain into its component parts. So what are the questions I think that we have to ask? The first one is, we have to recognize that oil price volatility is a matter of life. I mean, it is, we've had 7 since 1970, and those are the big ones. The first question is, do you physically have the organizational capability in-house to deliver a project? And I have seen some amazing things happen, certainly from my own experience, where people genuinely believe they knew how to do this. And what they were doing was classic project management from small modification projects, not proper governance structures associated with major investments. And there's a big difference. The second thing is, if you don't use your initial engineering assessment to assess what skills you need, you will end up in trouble. You've got to recognize the difference between classical project management and a gated governance process that requires external verification. And if there's one thing I've learned is the moment you bring an external team in to challenge what a team is doing, it's amazing some of the behaviors that you see. People say, don't you trust me? Well, as a CEO, you have to do it because you have to have an independent view. And today, many people have reporting systems related to projects that are actually done by contractors. So the dilemma here is the catch-22. The engineering companies we're working with, the question is, can they actually manage the whole cycle? And then what's the contract structures that exist to incentivize both the contractor and the oil and gas company to deliver on the outcome? And that the final piece, and we'll talk about politics very quickly, the final piece is recognizing that operations is a key part of a major project. They're not separated, and the challenge, particularly if you are worried about operating costs, is that you have to build an operations team at least 18 to 24 months before you even think about switching it on. And that means your operating costs go up, and everybody from the market turns around and says, well, hold on, lifting costs are going through the roof. They're going through the roof because you are doing something that is growing the company. And I think the final thing is the point I think everybody's made, which is educating investors. We do have a tendency of translating numbers or uncertainty into numbers and representing, with a slight bias, I think, the positive side of things. What we don't talk about is the risk. And in the absence of that, people assume that the rates of return will deliver will be the ones that we said at the beginning of the project. Now, all the data says that even in the best will in the world, even a P50 outcome says that you are going to be right once out of every 2 times. In other words, you're probably going to be wrong. Recognizing that and understanding that, and I think following through on some of the basic learnings that are in IPA or in any other advisory assessment will get us to a different place. But then you have to deal with the behaviors and the skills and issues that are going to get worse before they get better, unless there's a turnaround by the industry in regarding people as the business. Those are my observations.